My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Chris Brightman, the man behind the Research Affiliates Twitter handle. Chris, I've been reviewing a lot of your work. I'm actually quite excited for this conversation, but introduce yourself to the audience. Who are you? What's your background? As you get involved in markets? And is smart beta still smart?
Well, I'm the CEO and CIO of Research Affiliates. Research Affiliates is an investment management firm that focuses first and foremost on R&D, research and product design, and then partners with many of the world's leading investment management firms to employ those strategies in products that end investors can work with. Some of our largest clients include PIMCO, Schwab, Invesco, Legal & General, many others around the world. We create systematic or algorithmic investment strategies that provide the opportunity to outperform the market. I suppose you would say we tend to be value-oriented in many of our strategies, and that's not been a fun place to be recently, but we're quite enthusiastic that will provide attractive returns from today's fascinating entry point. And to your question, well, smart beta or the fundamental index or alternative approaches haven't looked smart this year, but over the broad sweep of history, they have delivered the opportunity for outperformance. And I think they still do looking forward.
Okay, so you got institutional clients coming to you looking for strategy development, product design, as you mentioned. I'm going to make the assumption that a lot of institutions come to you maybe a little bit late in the game, in the sense that, a lot of managers, they want to get access to strategies which are already working. And the problem, as you know, is that the moment people realize something's working, it might be closer to the end than the beginning. Talk through your career, those junctures where clients would come to you looking for some kind of factor-based approach where you yourself, wanting to fulfill the mandate of the client, had doubts about whether it would persist in the intermediate term.
So I've been 4 decades in the business. The first decade was really in banking, on the investment and the securitization side of the banking business, working for a bank to develop securitization deals so that we could fund the growth of our assets in excess of the growth of our deposits. And that kind of ended at the close of the 1980s with the real estate bust that your older listeners or our older listeners may remember. The younger ones may not, that the close of the decade of the 80s came with a big real estate bust and a lot of bank failures. And I had the good fortune to have pursued both an MBA and a CFA while I was working at a bank doing securitization deals. And so I was able to pivot to the investment management industry in the very early 1990s. And first half of that decade of the 90s, I was doing bond trading and portfolio management. And then I switched to equities and global equities. And what I remember was the very difficult time that the firm had in the close of the following decade, the end of the 1990s. So I worked at a firm called Brinson Partners, which in the early to mid 90s was probably the most well-respected, fastest growing firm. Ended up selling ourselves to Swiss Bank, which merged with UBS. And for a while, we were the first $1 trillion asset management firm that ever existed, the first firm to have $1 trillion in AUM. But what tripped us up was the tech bubble, with a discipline on assessing fair value of a business before you buy it. We couldn't bring ourselves to purchase firms like AOL or Cisco or many of the dot-coms. And so that was the sort of the end of my time there with UBS Asset Management. I think my last position there was head of global equity strategy for UBS Asset Management. And I went to DC area, Arlington, Virginia, across the river from DC, to work for an investment management outsourcing firm. And that was really fascinating. I ended up becoming the CIO of a firm called Strategic Investment Group and learned about not just the liquid public securities, but investing in private equity, hedge funds, private real estate, private credit, et cetera. and was then recruited down to work to manage the endowment at the University of Virginia. There, I was the CEO of the University of Virginia Investment Management Company. And that was a fascinating sort of 5-year detour into the nonprofit space. And I still spend a lot of time there, just kind of stepping down as longtime chair of the investment committee at my alma mater, Virginia Tech. But we see these, as you say, we see these cycles, and we're kind of back now with the infatuation with technology, and Nvidia now trading at 200 times its last year's earnings. I think the only time a huge company has ever done that before was and actually had a lot of earnings. If you have almost no earnings, you can trade at fabulous multiples of those if you're a small growth company. But for a huge company with real earnings like NVIDIA, I think Cisco's the best example. And of course, if you invested in Cisco in 2000 when it was trading at 200 times its prior year's earnings, you got a zero for the next quarter century, even though the growth trajectory was pretty fantastic. Cisco fundamentally was a great business and kind of grew in line with the most optimistic assessment of its growth opportunities. But you could overpay. People did at 200 times. And now we've got NVIDIA in the same sort of situation. So yeah, it's a difficult time in markets. However, to your other point, are we developing products that clients come to us and ask us to develop? And the answer is not really. We do some customization work if somebody wants something a little different than we have. But for the most part, we're trying to look ahead and develop the next products that people don't even know that they want now. I think our founder, Rob Arnott, is very fond of a story about Henry Ford. And when asked if he developed what the market wants, he said, absolutely not. If I had developed what the market wants, I would have created a faster horse.
I love that, by the way. So for the last decade, I've been on the fund management side of things, but it's been my observation that, to your point, the fund business, you tend to have all these products come out towards the peak because those strategy developers need to raise assets because it's expensive to run a fund, to run a mutual fund, run an ETF. And the best way to raise assets is when there's already hype around the strategy that you're developing. So while it makes a lot of sense to go for the areas which are not getting a lot of attention on the bet that they will get attention, new products in terms of just funds tend to not focus on that area because most people chase performance. And if there's no performance, it's hard to get a buy order.
Yeah, and this is a particularly difficult time for anybody that's marketing an active strategy, because if you look at the NASDAQ 100, for example, the position sizes of the top, pick your number, 5, 6, 8 large tech platform companies are such that you are poorly diversified. The NASDAQ 100 itself is poorly diversified. You can't really credibly come out and create a actively managed fund that has the concentration that naturally has emerged in the NASDAQ 100 and compete with it. Even Cathie Wood is faltering now.
Right. I made that point before. It's very hard to beat the S&P when the S&P is the only game in town. I mean, at the core, on a very basic level, I always go back to this point that to beat the average, you have to choose the right average. So usually you would tilt small cap or you tilt international. When the S&P is it, everyone piles in at the top. I shared at the top of the Twitter space here this point that you just referenced, which I agree with 100%. There's never been a time in history where the S&P had as much idiosyncratic risk as it has now.
Right. But of course, people are looking beyond the S&P. That's passé. It's now the NASDAQ 100.
Is there any parallel to that kind of late 90s run? I mean, a lot of people say, AI bubble, like the tech bubble. There's some parallels, but the other dynamics are not quite fitting that kind of historical example of, sample size of one. But what looks similar to the late 90s versus not similar?
Well, I think a lot, there's that hackneyed phrase attributed, I think, to Mark Twain that history rhymes, but it doesn't repeat. But I want to challenge the idea that it's just an anecdote. It's a single episode that was the tech bubble of the late 1990s. A decade before that, we had the bubble in all things Japan. And there were all kinds of articles published in peer-reviewed journals like the Financial Analyst Journal that absolutely tortured finance to explain why companies in Japan really did deserve to have 200 and 300 PE multiples. And of course, that was a bubble that ended badly. There was the Nifty 50, in the late 60s through the mid 70s before that. And if you go back and read financial history for it, I would highly recommend Devil Take the Hindmost. It's a bit of an older book. It's, published back in the late 1990s, but there's a long history of these sorts of manias and bubbles. It's not a new phenomenon in capital markets. Bubbles and crashes are the capital market equivalent of booms and recessions in the economy, which is, a normal feature of a market economy. So if you have a market economy, you're going to have booms and busts. And if you're going to have market determined capital market prices, you're going to have bubbles and crashes. Those are recurring features, and we're clearly in a bubble environment now.
But I'd argue that the duration of how long that type of bubble environment lasts shortens over time, just because of the ease with which people can express their manic tendencies on chasing price or doing zero DTE type of options trading. So there's a lot of people that would argue that the AI, if we are indeed an AI bubble, I suspect we probably are, that it could last for a while. My counter to that is maybe not, just because markets move faster than ever before.
Yeah, I mean, that's the whole point of the rhyme, but it doesn't repeat. I mean, if you try to go back and do technical analysis and say, I'm going to try to spot the patterns of the past to time the end of the present environment, I think that's a fool's errand. It looked like we were at the end with the great repricing that we had on tech platform companies and Tesla, a year ago. But now we're right back blowing through the valuation discrepancies that we had back then. So it's really, a fool's errand to say when or exactly how things are going to change. They typically do, but timing is uncertain.
Right. And that's always goes back to the point about it's ultimately about cycles. Anomalies have cycles, factors have cycles. And the problem with cycles is you don't know you're in a new one until 2 to 3 years after it's already taken place. One of the dynamics, which I think is intriguing beyond this idea of AI, is that for the last 30 some odd years, small caps have had the same performance as large caps. So if you look at Russell 2000 versus the S&P, they've had the same return, even though small caps obviously had a lot more risk. And I had a phase in my life when I would read all these different white papers on SRN. I know you guys publish a lot of stuff there too. There was always that idea that there's this small cap momentum drift, right? There's less analyst coverage. There should be better outperformance. How do you think through doing research on things that look good based on the historical data set, have a lot of reasoning and rationale, but then suddenly it just seems to break in practice? The small cap dynamic to me is a really fascinating one because it was so pushed out there as a way to generate alpha.
Well, of course, you had the original factor research that came out of the 60s and 70s and then was put in practice in the 80s, and the famous empirical discovery or observation from that early era of quantitative methods being applied to investment management was small in value, that there are persistent returns available to small companies and to underpriced companies, or companies that were priced lower than the higher priced companies, which of course are labeled growth stocks because presumably the explanation for why they're priced at a very high multiple is fabulous growth opportunities. See, NVIDIA today, Cisco, a quarter century ago, Japanese stocks a decade before that. And then, more recently, people discovered new factors, for example, quality. which always struck us as a bit of a odd factor to believe in, because who wouldn't want to own quality companies? Who's on the other side of your trade on the quality? And of course, there's no agreement on quality means many different things and different things to different people. But no sooner had that been discovered and money poured in, that it stopped working. So if you really want to kind of delve into what's going on with small, I think there's two issues. One is that it is less covered, so it's probably a better place to fish if you have an edge in security selection. But be careful, because there's an awful lot of other people fishing in that same pond. And so you're trading against others that might have better information advantage than you have from an active standpoint. From a passive standpoint, in other words, let's just own the Russell 2000, or let's buy a DFA fund that tilts towards small, you probably want to be aware that, to the extent that there is a return available there, and there has been over very long time horizons, though not recently, that's just value in different clothing. Let me explain briefly. There was a great series of articles published in the 90s. My favorite one was, Does Size Really Matter? And what it showed is that if you divvied up all of the stocks in the market into, say, quintiles, although you could have done quartiles or deciles, doesn't really matter, you'd see that the very largest companies had the lowest returns and the smallest companies had the highest returns. And there was what we call a monotonic relationship, meaning that if you went from the largest companies to the next largest, they had a little bit better returns, and then to the middle quintile, they had better returns, and into the fourth quartile, they had better returns, and the fifth quintile, meaning the smallest stocks, had the very best returns. But, and it was a guy named Burke that published this research, if you went back and said, hey, I'm not going to sort companies by their market capitalization, I'm going to sort them by other metrics like their sales or their book value or their earnings, what you find is that monotonic relationship, in fact, any relationship, completely disappeared. Companies with larger sales did just as well as companies with small sales. Companies with large book value did just as well as companies with small book value. But then if you go, so no relationship between size and quintiles by fundamental measures of a company's size. But if you went into each one of those individual quintiles and then sorted by market capitalization, so you're all companies that have about the same size sales, what about the performance of those with the biggest market cap versus the smallest market cap? It always came out that the companies with the smallest market cap had better returns than the companies with the largest market cap. Well, then you scratch your head and say, why does that happen? And the answer is, as Burke explained, and this study's been replicated many times, is that if you use market capitalization as your measure of size, you're not just measuring the size of the company, you're measuring the size of the company plus the multiple the company trades at. And so what you're just finding is that the reason that passively small companies have had higher returns than larger companies is because your metric for measuring size is market capitalization. And you're just showing that companies that trade at higher multiples have worse returns over the long run than companies that trade at smaller multiples. And so, since the late 1990s, those of us who study empirically capital markets and equity market strategies really understand that size and value are always going to work or not work at the same time, because they're just the same thing dressed up in different clothes.
No, I love that point, and I'll even expand it further. You can correct me if I'm wrong on this, but it seems that there's a similar dynamic when it comes to domestic versus international. So the folks at Crane Shares, who I know pretty well, would argue that one of the main reasons why emerging markets haven't really done so well is because value didn't do so well, that there's a connection between just even the sector composition of a lot of the emerging market indices to U.S. value style tilts. So it really is, at the end of the day, that tug of war between value versus growth. And then it's sort of, how's it dressed up? Is it international? Is it small cap? Et cetera, et cetera.
Yes, although, I would caution that it isn't always the US. It is the US now. It has been the US for quite some time. Perhaps the entire career of many people that are involved in the capital markets. But if you look at very long run history, centuries, you find that it is not always the US. I mean, my example of the 1990s, the 1980s, it was Japan. So the US was not the dominant driver of outperformance forever. In the 1980s, it was very much Japan. After then, you had the 90s, where it wasn't US tech stocks, it was global tech stocks. There was Nokia and Ericsson and Nortel. And for a time, there was an enormous boom in what was called the newer market in Germany, which is small startup companies. So it was really a global industry bubble that occurred in the latter half of the 1990s. And then in the 2000s, from about 2000 leading up to the global financial crisis, we had the BRICS phenomenon. And now we're back to the US, but it definitely is driven by momentum and excitement and bubble. And currently, most of those bubble companies, or almost all of them, are US companies right now. But it's not always the US that's leading the mania.
No, of course, certainly, just for the sake of an argument here, I do think that this one's odd in the last decade plus, purely because I'd make the case that it's largely driven by the manipulation of the Fed. So I put out a tweet before, basically looking at monthly return distributions for the S&P and then monthly return distributions for emerging markets pre-QE3, pre-ZIRP, September 2012, and then post the first rate hike from last year. And a really interesting dynamic started taking place with the Fed's interest rate policy and monetary policy, which is it effectively cut off left tail risk. That you didn't have a fat left tail in the distribution of monthly returns for U.S. markets, whereas everything else internationally did. So that concentration of momentum in U.S. mega cap does have that support from the Fed over the last decade. Now we'll see if that's over, but I think that's sort of another interesting dynamic, to the extent that now you've taken away QE, or at least reduced the possibility of going back to ZIRP. That should change the way the risk manifests, I would think.
I think that's fascinating that you bring that up. And I take great interest in the linkages between the financial markets, or the capital markets, and the macroeconomy. And there, I think that the monetary policy element that you just described is important, but it's kind of as important to look at the fiscal dimension. There's a linkage between deficit spending and corporate profits that I think too few are familiar with, too few understand. If people want to investigate it, perhaps the best place to look is papers on what's called the Kalecki profit equation. The Levy Institute has a good collection of papers on the subject. At the end of the day, it's just kind of an accounting identity that says that savings equals investment, and corporate savings are basically profits. That's sort of the excess of, profits are the excess cash flow that corporations get over their costs, and that's corporate savings. And savings and investment, from a sort of an accounting identity standpoint, have to add up to the same thing. They have to equal. And the government sometimes can run a balanced budget. But if it doesn't, if it runs a deficit, that's dissavings. So the dissavings of government budget deficits have to be the savings of somebody else. And since individuals tend, as a sector, not individual people, but the household sector doesn't have huge swings in its savings to the degree that the government does. So what absorbs that is corporate savings. So there is both theoretically as well as confirmed by empirical studies, if we just observe it, there's this very tight relationship to government budget deficits and corporate profits. So, yes, the Fed is part of it, but the enormous injection of liquidity into the system that we just experienced during COVID and then after COVID, Biden came in and doubled down. If Trump can send everybody checks, we can send everybody even more checks, and that inflates corporate profits. Are we at the end of that? I'm not so sure as you are. I mean, I heard you say things about we're not going back to zero interest rate policy. QE is ending. We're never going to do that again. I'm not at all sure. I wouldn't be surprised at all if the next recession tends to be a bit worse than people are hoping, that we couldn't get right back to zero interest rates and QE and blow out deficits again.
Yeah, and maybe just to be clear, I don't think we would be there soon, only from the perspective that I think optically it would look very bad because inflation lags, right? If suddenly the Fed were to lower rates because of what looks like a credit event, while headline inflation is still pushing 5-6%. So I would think there would be pressure to try to do such an aggressive move because the American public don't understand the leads and lags of monetary policy, inflation, and credit spreads.
Yeah. So sure. To the extent that we are looking at an unemployment rate below 5%, and inflation is still running well above, say, 3%, I think you're right that the Fed will have a difficult time pivoting to an aggressive aggressive stimulus. But I think there's ample probability, and I'm not saying that it's greater than 50%, but there's ample probability that we see something much worse. I mean, we had a negative 13% return in the bond market last calendar year. A typical bank has equity capital of about 6%. So we had the bond market decline in price by double or more the typical equity capital of a bank. Look, and that's the investment grade bond market. That's treasuries, investment grade corporates, investment grade asset backed securities, duration of about 4 or 5 years. What do you think a typical bank balance sheet looks like compared to the investment grade bond index? Probably, absolutely not as high quality, potentially just as long duration, nowhere near as liquid. So, we remain in a precarious situation with respect to bank capital. And the recession hasn't even arrived yet. So I just, point out that there's considerable uncertainty about how severe the recession is going to be when it comes. I think you could argue when it's going to arrive. I think it's fanciful to believe that the business cycle has been revoked and we're never going to have a recession again. I'm in the camp of thinking it's going to be relatively soon because all of the historical indicators that have predicted recessions before are all flashing red. The only thing that's not flashing red, of course, is the unemployment rate. But we all know that employment is the most lagging of lagging indicators. So, is employment going to be behaved? Is the Fed not going to have to fight a spike up in unemployment? I don't know. I think it's fascinating to watch. Personally, I think it's wise to stay a little more liquid. And we kind of like duration at this point, even though over a longer term horizon, I'm very worried about the unsustainable fiscal position of the United States. And I say unsustainable from a political standpoint, right? Like, we could all, on the back of an envelope this morning, come up with policy changes that would create balanced budgets in the US, but there's just no political will to do so. And I think we're going to have the calamity that prompts the change until there's a crisis that forces a change in our fiscal position. We're going to have a problem. So I'm quite bearish on inflation over the longer term. But that doesn't mean that long bonds aren't going to be your friend come the recession that's going to occur second half of this year, or maybe not until 2024, though I'd bet heavily on the second half of this year.
And I'll bring some of the audience here, but I always go back to being long or bullish duration basically means you're bullish default risk, because I mean it's effectively the flight to safety dynamic, right? Credit spreads widen, volatility increases. That's why you end up having long duration treasuries, be sort of the beneficiary of that as opposed to the source of it like it was last year.
So, we think that there's safety, that when you have a bear market, bonds are your friend and they're your diversification. And I think that continues to be correct, but it comes with a couple of caveats. The first caveat is to say that we kind of expect a negative correlation doesn't mean that there's any airtight guarantee that every time stocks go down, bonds go up. Maybe 9 times out of 10 or 19 times out of 20, you're going to get that. But 1 out of 10 years or 1 out of 20 years, you're going to have a year where it doesn't work out that way. And just last year happened to be that 1 out of 10 or 1 out of 20 years where you get a positive correlation between stocks and bonds. So that's my first caveat. My second caveat is no, it's not just randomness. It's also what's the macro environment. And when the real economy is the driving security prices, then you have a negative correlation between stocks and bonds. But if you're in a high and volatile inflation environment, then you get a positive correlation between stocks and bonds, meaning if what's driving down equity prices is rising inflation, bonds are going to be, you're not going to have any safety in the bond market. But I think we're on the other side of that trend for the near term. In other words, inflation is headed down. If we go into a recession, inflation is going to be headed down even further. People are going to extrapolate that even further. And so I think while, yes, 2022 was a very difficult year for the traditional stock and bond portfolio, the very next cycle, the one coming on right now, you'll still want the bonds as your diversification.
Let me just reset the room for the remaining minutes here. Everybody, please make sure you follow the Research Affiliates Twitter account here. If any of you want to come up and ask questions before we wrap up, click that bottom left mic request button. And as always, this will be under Lead Lag Live.
I'm in that camp. I think putting Powell, the person, aside for the moment, and they say they're data driven. I think they absolutely are data driven, and they don't really have, other than, maybe getting a day or two early look at some of the economic indicators, they really don't have access to data that all the rest of us don't have. So you can model out pretty much what the Fed's going to do and understand why it does it. The Fed much more reacts to the economy and to financial markets than they drive the economy and financial markets. As for Powell, the person, I think he's an earnest, hard-working, public servant, though it's worth understanding he's not an economist, he's a lawyer and a politician. And while I personally don't, believe that there's any ill intent in his leadership of the Fed, it's very obvious that the Fed made a horrible mistake recently by becoming too reactive. They changed their policy to say we're going to do this average inflation targeting, which is mean we're going to go ahead and miss on the upside. We're going to let inflation run hot for a while before we tighten, which was just a horrible idea. And what happened is exactly what we got, which is if you wait to tighten until it's obvious that you should have tightened before, you're going to be behind the curve, and they're behind the curve. Are they going to repeat that on the other side? I suspect they probably are. So, the problem with Powell is he got enamored of this whole idea of average inflation targeting and not being preemptive. And he's loath to flip-flop and start being preemptive again. So now we've got a reactive Fed, which accentuates and worsens the cycle instead of tries to preempt it. And that's where we are.
But real quick, I'll add, I think the problem is the mindset, right? So I always refer back to Bernanke's 60-minute interview, in February, and he was asked, how much confidence do you have that the Fed can control this being inflation? And his response was, we can raise interest rates in 15 minutes if we have to. It was very kind of flippant, sort of, we can control inflation, and we have to get out of the deflation post-GFC. So I think you can correct me if I'm wrong on that, Chris, but I think it's sort of they view the zero bound and the no ceiling very differently, when in reality, it's the same dilemma, which is that they can't predict the future and they're simply responding, and inflation gets out of control faster than even their models would suggest.
Yes, and I agree with everything that you said, but even worse, what Powell got talked into was this notion that we're going to have a change in the forward guidance that's provided. And until inflation runs well above target for a prolonged period of time, we're not going to tighten. That was the forward guidance that was provided to try to get away from the lower zero bound. And rather than really be data driven and pivot away from that, when it became obvious that was not the right policy prescription to the post-COVID environment, he, for political reasons, decided, no, we've got to establish the credibility of the Fed. We said we were going to do that. God damn it, we're going to do it, and they did it, which was a horrible mistake.
I want to take it back to strategy development, design. What could work in the next cycle, or maybe the cycle that we're already in that we don't realize is the next cycle until down the line. You hit on value, assuming this AI hype at some point passes, or maybe is in the process of passing. What are some things that you yourself think are intriguing that would be sort of leaders that nobody sees coming?
Well, I think we are going to find a situation where we have a prolonged period of the average stock outperforming the markets. And I think the aftermath of the tech bubble is the perfect analogy. It looked like there was a huge correction in the indices in the early 2000s. But if you looked at the equal weighted S&P 500, there was no real bear market. It was just a correction in a very small handful of high-flying names. When is that going to happen? Who knows? I can tell you there are timing tools, and momentum is the timing tool. So, I mean, I hesitate to recommend this because most individual investors don't get the timing right. But if you saw the Nasdaq start to underperform for a month or two or three or four the S&P, and the S&P start to underperform the equal weighted S&P, that's the signal that you want to get out of the high flyers, be into a value strategy or an equal weighted strategy or a fundamentally weighted strategy. And the average stock is not really particularly overpriced. The US market is overpriced, but the US market is overpriced just because of a handful of extraordinarily expensively priced companies. The average stock in the market, there are many small stocks and medium-sized stocks that have ample opportunity to provide terrific returns, and international stocks, both developed and emerging. Really, the overvaluation, the problem is just a handful of hugely priced stocks. So when do you want to see when to flip? If you are playing that game, is momentum. There's no better timing tool than momentum.
Chris, I know you do a lot of institutional work, obviously, but for those in the audience that maybe are not in the financial advisory community but want to learn more about some of the stuff that you do or read some of your research, where can you point them?
Well, you can go to www.researchaffiliates.com, or if you want a shorter, you just go to www.rallc.com, take you to the same place, and you get to see all of our research. If you're interested in investigating how to invest in our strategies, we have a section on our website said how to invest. They're not our funds. They're funds of our business partners, Schwab and Invesco and PIMCO, among others. There's dozens of funds that are available for folks to invest in. Again, you can find that on our website.
That's a good place to wrap this Twitter space up. Special thanks to Chris, everybody else that's here. Hopefully, I will see you all again on my next Twitter space. And again, this will be on Lead Lag Live, on Spotify, Apple, so on and so forth. Thank you, Chris. I appreciate the flexibility and your knowledge here.
Oh, thank you for the opportunity.